This is On the Market, a Bigger Pockets podcast presented by Fundrise. Hey everyone, welcome to On the Market. I'm your host, Dave Meyer, joined today by Jamil Damji, Kathy Fettke, Henry Washington. What's going on, everyone?
Yo, what's up?
Ooh, excited for a debate today.
Yeah, this one's going to be fun.
I like debates because the last time we did one, I won.
You did. We don't have point. Maybe I'll assign some points here. I don't know. Last time was at BPCon, and Jamil famously destroyed everyone else and won the right to plan an episode of On the Market. I don't think we have stakes for this one, but I am still looking forward to a spirited debate because we have a topic that is definitely controversial right now. And we're going to be talking about whether or not we are in a recession right now, if we are going into a recession. We're also going to talk about whether or not we were in a recession last year. And I am looking forward to this conversation. I have no idea how any of you feel about this. So I think it's going to be fun to talk about this.
What happens if we all agree?
I will pretend I disagree with you to make some drama.
Perfect.
Well, unless, maybe I will naturally disagree.
He'll play devil's advocate.
Yeah, exactly. So that is what we got on tap for you guys. Just so you know, that the reason that this is a debate in the first place is because the way a recession is defined in the United States is by a government entity called the National Bureau of Economic Research, and they do it retroactively, right? So they basically wait until well after sort of the economic turmoil has happened. And then they say like, okay, this is when the recession started. This is when it ended. But it could be years after it started. Like in the Great Recession, things started falling apart in 2007, 2008. It wasn't until 2009 that they said the recession started back in 2007, for example. And I know some people believe that this has changed over time and that the government has changed the way that recessions are defined. That is not true. This is the way it's been defined since 2000 or back into the 1970s. But I will just say that because the way that we define recessions is sort of confusing and retroactive, most people use the definition of 2 consecutive quarters of GDP declines. That is what, most people talk about. And so we're going to talk about today whether we think that is an appropriate definition of a recession. And if so, are we in one? Are we not in one? And get into all of that. So this will be a really fun conversation. I think we'll learn about a lot. We're going to talk about what indicators everyone follows to track if we're in a recession or not. So we're going to get into that in just a second. But first, we're going to take a quick break. Okay, let's jump into this topic. Before we get into talking about today, let's talk about last year, because as I said at the top of the show, the traditional, sort of commonly used definition of recession, 2 consecutive quarters of GDP declines, which we saw in 2022. First and second quarter, we saw real GDP declines, but to date, we have not heard from the National Bureau of Economic Research that we were in a recession. They still could do that retroactively. Haven't said it yet. So Kathy, let's start with you. What do you think? Were we in a recession last year?
We might look back and say that was the recession that everybody was panicking about. We really don't know. And I think we will look back and it'll be crystal clear at some point. But I would say that there were certainly industries in recession. Real estate, one of them. Real estate sales, definitely in a recession, but not everything else. I mean, job growth still strong, and we had 2 consecutive positive GDPs right afterwards.
Yeah, it's very, very strange. Last year was a very weird time because some markets were. I guess we're going to say that a lot probably over the course of this episode. But yeah, we did see those 2 consecutive quarters of GDP growth. And I should probably say, if you don't know, GDP stands for gross domestic product. It is basically a measurement of the total economic output of the entire country. And so we saw in the first 2 quarters of 2022 that GDP fell on a real basis, which means that it was actually growing, but when you accounted for inflation, it was actually declining due to the inflation. So that's what happened last year. But curious to hear from Henry. What do you think? Was that considered a recession?
Yeah. So first, let me caveat this. I am no economist. So everything that I think is based on what I see and how I feel. Well, that's pretty much how I run my life anyway. But when I look back at 2022, I think so how I judge a recession in my mind is how are people responding to the negative impacts that are happening because of this quote unquote recession, right? And when I think about 2022, the thing I think about is consumer spending would definitely go down in a recession because people are holding on to their dollars a little tighter. Inflation was, starting to rise. And so that money means more to people. And it's more about spending money on the things that you have to spend money on to feed your family and provide shelter. So consumer spending typically goes down. But when I looked at consumer spending in 2022, it was up, right? It was up 5.9% year over year. Right. We went from 141 billion to 142 billion in consumer spending. So if that tells me that if we were in a recession, because we had the 2 negative quarters of GDP, that the news didn't get to people yet, or that people weren't as impacted yet, or the impact was to come in the future. And if you look at consumer spending now, it's down just a little bit, but it doesn't feel like a recession. So I would say no.
All right. Well, I think we should all caveat that we are not economists. We're just playing one on this podcast. But we do, I think, follow it closely enough that our opinions are at least well informed, I hope. Jamil, what about you? What do you think?
Well, it's interesting that Henry is using indicators that I think actually matter, right? How do things feel? What does it look like and what does it feel like? Because, I'm 45 years old, just turned 45, and I've been through a few recessions. And I can tell you that the ones that I can remember, I actually felt them. I felt them, right? Regardless of whether I was an entrepreneur or I was in a W-2 situation, I felt the recession. I understood that, things are different right now. We're tightening up. We're not spending. Life has adjusted. And we're making adjustments through it, right? And so I really do think that we have to look at these types of conversations and take into consideration how the broader country or how we're feeling as a nation with respect to our economics. And so, the fact that we had 2 declining GDP quarters consecutively, which is the definition of a recession, and yet we have a failure to call it. It's an interesting thing, right? Why not? Why not just call it, right? So if this is the indicator, call it. You saw it, it happened, call it. It's okay. It's okay to say the things, right? So the reason I bring this up is because I want to propose new indicators. Because if we're not going to say that 2 declining GDP quarters or consecutively declining GDP quarters are a recession, then I propose new indicators. I propose that you go to a major metropolitan city, you get 10 miles away from the airport, and then you look at the number of Uber X's and the number of Uber Blacks that are available at 8 a.m. in the morning. If the number of Uber X's is less than the number of Uber Blacks, then we are in a recession.
Yeah, and you could add to that if you can get a reservation at the restaurant you want to go to.
Yes.
Oh, I see. Okay.
Yes. Because it's about feelings, right? If I can get an Uber Black a lot easier than I can get an Uber X, then I know that people are spending money because we got the black cars out there, right? So how can it be a recession?
There's this very funny recession indicator. I don't know its historical performance, but it's men's underwear, that you could predict recession by men's underwear because men just don't want to buy new underwear ever. And they will basically only do it during like really good economic times when they're feeling flush, and like every other time they're just like, I'll just wear the same men's underwear.
So wait, are we in a recession if you go commando? Is that what it is? Like, all the men are commando. We are in a recession.
Yes, basically, yes.
I think you're onto something.
The number of holes in your underwear are like the reflection of whether
I think you're onto something. I only buy my undies when I'm in a good mood, typically financially, because them Duluth
Exactly
trading
right.
underwear ain't cheap, man. You gotta go. You spend $25 on a pair of underwear. You got to be feeling good about life.
Whoa!
Damn, those are some expensive chuddies you got.
Hey, man, only
And
the
then
best.
with women, it's just when Victoria's Secret is having a sale. That's when you buy your undies.
Yeah, yes. Women are more like civilized people who will continue to buy the clothes they need despite the economic situation. Men are like, you know what, I can cut back on underwear.
Well, some people, I don't know if you guys have heard this, but some people are calling this the white collar recession or the Patagonia vest recession. Have you heard that?
No, but I'm wearing a Patagonia sweatshirt right now, so
that, obviously people that got hurt, or a lot of people have been affected by the rising interest rates and the attempt to create a recession by the Federal Reserve, and so a lot of people have lost, or their net worth has gone down in the stock market, certainly in crypto. And, short-term rentals income has gone down.
Yep.
And so they're saying it's really affecting the net worth of those who had a higher net worth last year.
It kind of makes sense, right? If you just look at the like high-profile layoffs that have been coming through the economy over the last couple months, there tend to be really high-paying jobs in sectors like finance and tech. Are sort of leading the way. And if you look at the recent jobs report, which we'll get into in a little bit, there's actually pretty strong job growth across the board, but, particularly robust in things like hospitality and service sectors that are not traditionally as high paying.
Yeah, so I think the bottom line is you're feeling a recession. If you lost your job, that's going to feel recessionary. And we probably know a lot of people who are in the tech space and certainly, again, in industries where higher interest rates are affected, and that would be real estate. Anyone in real estate sales is affected. I have a close friend someone we know just lost their job. And that is why we love real estate, right? The more income producing assets you have, the less you worry about losing your job.
That's for sure. The one thing I do want to say about last year before we get into current stuff is I'm more current. I keep thinking about this fact that like the first half of 2022 is when we saw GDP declines, which a lot of people believe, would say that is a recession. That's how a lot of people define it. But economic, optimism was still pretty high then. And then it sort of switched. Like GDP started growing again in Q3 and Q4 of 2022, but everyone got really pessimistic and really upset about it. So I'm just curious, like it's just this weird thing where it doesn't seem like people's sentiment and the data about the economy are actually lined up right now. Just curious if any of you have any thoughts about that.
I think, honestly, that's one of the most perplexing things that we have about this, and probably why we haven't called it anyways, right, is that sentiment, optimism has been strong, and we've all felt that, even though typically real estate feels a recession first, so it's like first in, first out, right? We feel it. We're the industry that feels it immediately, and we typically feel it when we're coming out faster because of mortgage rates declining and an uptick in housing activity, right? And so it's one of these interesting dichotomies, is that, again, back to what Henry is talking about, sentiment, right? The overall feeling. Even though we were losing money in the same quarters that GDP was declining, and I can tell you that, and looking back at our P&Ls, like, oh, wow, we lost money on this flip, we lost money on this flip. Meanwhile, the sentiment out there was still very strong, and there were more Uber Blacks available than there were Uber X's.
All right. Well, along those lines, I'm curious, like, now it seems to me that sentiment is very low. I think, I feel it. I feel like my sentiment has really declined over the last year, just about the economy in general. What do you think, Jamil? Like, are you feeling like the economy today is in a recession, or are we heading towards a recession, or what are you thinking about sort of the future?
Interestingly enough, I'm again going to defer back to our beautiful friend Henry here and say I'm starting to feel optimism again. I had the pessimism. I felt that, oh my God, like especially going into the holidays and 2 months prior to that, from Thanksgiving to Christmas, it's been miserable in the housing market, right? Like it's, and again, if you're selling, if you got flips on the market or you're selling, you felt that. You felt a lot of pressure. You felt just, where is everybody? How come there's just not a lot of activity? And maybe I'm just myopic because I'm talking about a market like Phoenix where we really felt that more than, say, how Henry felt in Northwest Arkansas. However, after the Christmas holiday, I have not seen as much or felt as much strong investor activity, strong buying optimism. I mean, pendings are spiking. We can't keep inventory. We just can't keep inventory on our books. We pick up a house, we sell a house. We pick up a house, we sell a house, and it's like, oh wow, okay. I thought we were going to kind of loosen our tighten things up around here, but it looks like we're putting out more money and taking in more opportunities. And it's also interesting that I have friends in the vehicle industry, right? And so they had situations where, their car lots were just swollen full of inventory because they had overbought because of, there was a shortage of vehicles for a time. And so dealers were overpaying and buying. And anyone who bought a car last year understands what I'm talking about right now. We very likely overpaid for our vehicle if you bought last year. Well, I am talking to my friends that are in the car industry, and they're also saying right now, Jamil, we can't keep inventory on our lots. We just can't. And right before the holidays, from Thanksgiving to Christmas, we were all tremendously worried, and we had no idea what was going to happen, if we were going to go bankrupt, if we were, needed to get more credit. We were all worried. And after the holiday, things have just exploded. And so right now, I'm like Henry said, I'm optimistic. My sentiment right now is it's pretty good. I feel things are picking up, and like housing should be, we were first in, I felt it. We're first out, I feel it.
All right. Well, yeah, by those two indicators, housing and the car market, there's definitely a pickup in activity over the last couple of months. Henry, what about you? Are there any indicators or data points that you look at to try and assess the current economic condition?
Well, yeah. So there's the general indicators, right, that everybody looks at. GDP, 2.9%, right? That's up. Unemployment, 3.4%, right? That's good.
Historic lows. Yeah.
Historic lows, right? January, you got job claims at 183,000. So that's a 9-month low, right? So those indicators are telling us, no, we're not in a recession. There are some indicators that may be telling us, yes, we are. But those are the key indicators people look at. But again, feelings, right? So not only how I feel, because I feel exactly how Jamil feels, right? But if you look at how other people feel, if you look at consumer confidence is super high right now. And part of the reason that that's super high is if you've been paying attention to the stock market over the past few weeks, these earnings reports have been coming out, and a lot of companies are reporting beating earnings, right? You have somewhat 69% of the companies that have actually reported earnings above their targets, right? So that is going to make not only people feel more confident in the economy, but it's going to make companies feel more confident in the economy. And if companies are feeling confident, then they're going to go out and continue to spend money. They're going to invest in new projects and new technologies. They're going to go out and invest in new jobs and hiring people that are going to help them hit their goals for the next quarter. So if they're feeling confident, people feel confident. If people feel confident, people spend money. If people spend money, it's a benefit for us in the real estate space.
Well said. Kathy, what do you think?
We're in opposite land. It's such a strange time to look at the data that we get and be concerned about it. And that data, by that data, I mean 517,000 new jobs created. This beat expectations by double, even triple by some economists. And this is after almost a full year of the Fed trying to slow things down and raising interest rates in an unprecedented way. So, no, you can't be in a recession when you're creating that many new jobs, when businesses are hiring that many new people and not laying off people. And then retail sales up 3% in January. So they're spending money. And you see it when at least for me, when I go out, and again, I was serious trying to get a reservation at certain restaurants, you can't get in. You can't get in. So, this would normally be great news, right? But people are panicked by news like this, by good economic news, because that means that the Fed may continue to raise rates. Mm-hmm. But what I want to say about that is they already said they were going to do that. So don't panic. The Fed has been pretty clear about what their plans are, which is to get the the Fed fund rate, the overnight lending rate, above 5%. It's not there yet. We're at 4.5% to 4.75%. They already told us that they're going to keep raising. So don't be shocked. They are planning to continue to raise rates and to hold them there. I've heard lots of people say, as soon as they get to 2023, they're going to start reversing and lowering rates because it's going to slow things down. And that's not what they're saying. They've been pretty accurate about what they forecast. They tell people what they're going to do, and generally investors, certainly stock market investors, listen. And we have a ways to go. They're going to raise rates a few more times and most likely hold it there for the rest of the year. And especially after these massive economic numbers that have come in showing that the economy is strong. So, no, I don't see, we couldn't possibly be in a recession if the Fed's raising rates and we're having job growth and people are spending money.
Kathy, do you think that there may be just some possibility that people are starting to listen to what the Fed's saying and trust them at their word, right? And so do you think that there may be just this increase in activity because people are just trying to beat lending costs getting even more expensive, or is this activity real and not just like artificially motivated?
Well, rates, if we're talking about housing and what you're feeling in your industry and our industry, is rates did go down over December and January. Right. And I think that's what we felt. At our business at Real Wealth, we're booming again. People flocking. We do one webinar and everything sells. So it's like, yeah, we're back. But that was because rates went down and numbers started to make sense again. Now they're going back up again because the feedback we're getting on the economy is it's booming. And generally people get out, investors start to invest back in the stock market and out of bonds. And if they're buying bonds, rates come down. If they're not buying bonds, rates go up. And that's where we're at. So we could feel that. And we could be having a different conversation next month in terms of real estate going, things slowed again because rates went up a bit. But that's just our industry. That's not America.
That's not the economy overall. Yeah.
Yeah.
I think Kathy, you made a good point that we're in this weird situation where like good economic news is felt like bad economic news because it means right. that the Fed is going to continue to raise rates, and then there's this like pending economic downturn that's just always sort of like 6 to 12 months ahead of us. At least that's what it's felt like for the last.
Do you not feel like we're being gaslighted a little bit?
Man,
I just think everybody's panicking. Everybody's afraid of losing everything, right? Nobody wants another 2008. No one wants to start over again and lose everything. So there's been people predicting recessions and housing crashes for the past 10 years. It's nothing new.
Look, I'm with conspiracy theory Jamil on this one. You create the fear, people start panicking, they start panic selling, and then the wealthy take advantage, man. They go out and scoop stuff up at a discount.
We're just gaslighting everybody playing games to come in and gain.
Yeah.
Well, I think there is truth to that because Well, I don't know if it's a conspiracy theory. I have no idea. But I think there is some element that like the Fed and the government like wants people to stop spending money. They want you to be afraid, not necessarily because it benefits rich people. Maybe it does. But they definitely want that because that will help inflation, right? Like if people are afraid and stop spending as much money, then that would help curb inflation, and the Fed would be delighted with that to happen.
Sorry, I have to go. There's people with black suits at my door.
But I also want to get back to something you said, Jamil. Is like, I do think there is like, they call it like the dead cat bounce. Like, I do think there is a pretty good chance that like Q1 of this year for the housing market looks pretty good. And then it slows down again because, inflation data came out this week. It was down a little bit, but it was not a very good inflation report, generally speaking. And it's that combined with, what Kathy was talking about with the jobs report, it's just basically giving the Fed a green light to keep raising rates aggressively. And so, we were seeing mortgage rates start to slide on sort of these recessionary fears. But now I think there's a good chance the terminal rate, like what the Fed goes up to, is going to be higher than 5. It could be 5.5. And I think there's a good chance that we see mortgage rates now go up to somewhere near 7.5 over the course of this year. Or we go into recession and it goes the other way. It's like, it's just super hard to tell. And like my read on this is like, when it's all said and done, if we're looking back at this like 5 years from now, they're going to call this whole thing, I don't know if they're going to call it a recession, but from like 2022 to through 2024 is just going to be like this weird half recession, half not recession, where like some parts of the economy are doing really well and some parts are doing really poorly. And we're not going to ever have this like, quote unquote recession where you feel it, like you were talking about, Jamil, where like everything goes down. It's going to be like this sort of like whack-a-mole situation where like jobs are up, housing's down, cars are good, like where we just have this weird thing.
Yeah, it's a recession mullet. From the front, party in the back.
What's the? I don't even know what to say to that. But I like that idea. Do you think that makes sense? Am I off base?
Not
It just
at all.
feels like
I don't think you're off base.
we're
at all.
all trying to like call it a recession, like quote unquote, but like the economic situation we're in like defies normal words for it. Like no one's calling it a recession because it's just different than any other economic situation we've ever been in. That doesn't mean it's not bad. It doesn't mean it's not painful. It is bad and painful. But there are also good parts of it. So it's like just really hard to like fit this situation into our conventional definitions of economic cycles.
I mean, if you boil it all down to what is so different and weird this time around, besides the fact that we had a global pandemic that none of us have experienced before, is that the Fed created over $3 trillion in a matter of 13 months. And that is a huge shock to the system, I suppose, in a good way, where money went to the people. And a lot, we talk about the stimulus checks, but those PPP loans, those loans that went to businesses sometimes were in the millions. And it was sometimes to businesses that maybe, didn't need that money, but they got that money and that's extra. And that where did that go? Usually when there's profits, it goes to the owners or the shareholders, and then that goes out into the economy. Generally, people spend it or they invest it. So, we're still in the hangover of that. That was a lot of money that perhaps was spent on buying all cash properties or buying things that without debt. We know that homeowners are in a really, really good position right now because many of them have a lot of equity still. They have high equity and super low payments. So that's just another example of so much money that was easy to get. And if you were borrowing it, it was low debt, that people are just not, when I say people, I don't want to say all people, but a lot of people still have money, whether it's in savings or they have the things that they wanted and bought with cash at the time. So it's going to take a while, I think, for that amount of stimulus to trickle down and to trickle out of the economy. And the Fed doesn't want to talk about that part of it. Nobody seems to want to talk about that part of it, the over stimulus.
Well, I think what's interesting, Kathy, is that in 10 years, they're going to have a report. And it's going to be all of the things that were bought with PPP loans.
Oh, did you see the one recently?
I didn't even know this existed yet.
There are some. The government is starting to go after people for fraud, and one of them was an influencer. This woman who was an influencer got like plastic surgery with a PPP loan because her business was like her.
Was she a stripper or something?
I don't know. I didn't look into it that much, but it was kind of like her business is her appearance. So she basically got a,
like
yeah. Yeah, but he doesn't need money for it. That's all natural.
So you did no market research on that, right? That's what we're...
Not that I'm willing to talk about on the show. I'm not going to tell you how I know about this story, Henry.
Were there Lamborghinis? Were there luxury mansions? Like, what got bought with the PPP? You know what I mean?
Yes. Yeah. There's definitely going to be a reckoning for that.
And a few rap songs, I bet.
Yeah. Yes, probably. Well, so I'm curious, like, how, are we all in agreement that, like, I don't know. I guess my feeling is I don't know if they're ever going to call it a recession or not. Like, that's out of my hands. But I do think this economic uncertainty that we're all experiencing is at least all of 2023 and probably into next year. I don't know. Do you guys feel differently about that?
I hope I don't. I mean, again, as I mentioned earlier, it could be the dead cat bounce, or it could just be a return to normality in housing. But I'm optimistic. I truly believe that 2023 isn't going to be as bad as we had expected it to be. If I'm looking back at the last 2 quarters of 2022, I had some definite anxiety about what 2023 was going to look like, and that anxiety is beginning to soften.
Well, that's good. I like your optimism. I mean, just by the fact that how wrong economic projections tend to be, the fact that most economists believe that there will be a recession probably just by default means that there probably won't be. Except I am a believer in the yield curve. I don't know how much you guys follow this, but that is the most reliable predictor of recessions that we have, pretty much, and that does point to a recession. So that one, every time I start to feel some optimism about the economy, I look back at that. I'm like, oh no, we're screwed.
I think the big caveat there is exactly what Kathy mentioned. Yeah, I mean, the indicators that we're using are the indicators we've used historically, but historically we haven't had this pandemic, which created its own problems, and then yes, the Fed created money, right? And in order to help people, I don't want to say that the stimulus was bad or PPP was bad. It was created for a reason. There were people who absolutely needed those stimulus, right? Absolutely. We're very fortunate here that, we didn't need those things. But when the pandemic first hit, I remember seeing people at the grocery store. I paid for a lady's gas who was in tears because she didn't know how she was going to be able to keep gas in her car, right? And so the money was created, I think, for the right reasons, and there were tons and tons of people, tons and tons of small businesses who needed PPP funds. Does that mean people didn't take advantage of it? Of course people did. But I think it was created for the right reasons. But that's this big caveat, I think, that's causing a lot of these, what you call it, whack-a-mole of of the economy, right? Industries up and down. We've had this huge outlier of a recession. And so, yeah, I don't think we're going to be in a recession. I don't think it's as bad as people think it's going to be. And, who knows? Maybe I'm terribly wrong. But I don't know. It's hard to believe or follow the indicators when this historically hasn't happened before.
And here's where the debate part will come in. I do think that, first of all, it's nearly impossible to predict anything anymore because we don't really know what the Fed is going to do or how quickly they're going to move given the very, very strong economic data. If they do what they've said they're going to do, they would raise rates throughout 2023 gradually at 0.25% hikes, which is a lot better than 0.75% hikes, until they get to 5 or 5.25%. So that would be, several more 0.25% hikes this year and then holding it. What we don't know is how that's going to impact what appears to be a pretty strong economy from all that money. I'm going to say the economy's strong because if you or I took out a $3 trillion credit line, we'd probably be looking pretty good too, and that's where we're at. It's just still a lot of money circulating out there because of all that stimulus. So will being at 5% Fed fund rate stabilize things or send us into recession? It doesn't look like, and most economists are now not predicting it for 2023, that it will be just flat, just a GDP of just kind of maybe 0.5% or something like that over 2023, which is great, right? If we just hold, that would be wonderful. The question is, what will 2024 be like? And is that something that we should worry about? And that's what we're going to see in the headlines is, okay, this year's going to be okay, but just wait till 2024. And that's the unknown. So we're not out of it yet. The recession headlines are going to be with us. How do you deal with it? That's really the question, is how do you deal with it? How's it going to affect you? It's probably not going to be a 2008 type of collapse, although there's people out there saying it will be. But there's always people out there saying it will be. So that question mark will always be there. It says, how do you operate and live with that hanging over your head for another year or two?
Totally. Yeah. I don't wish for a recession or want anyone to lose their job, but like it almost in some ways would be better if it just got over with, because it's just dragging this out for a long time, this like economic uncertainty and fear that everyone, myself included, has. And I just want to say, like, the scenario you're describing, Kathy, which I think is a reasonable scenario, I is probably the worst case scenario for housing prices. If interest rates go up, but we do not go into a recession, in my mind, is the most likely scenario that could actually lead to a housing crash, right? Because then interest rates are going up, that puts upward pressure on mortgage rates. But without the recession to help, just so everyone knows, a recession usually pulls down mortgage rates. So if interest rates go up, but there's no recession, that puts the most of all the scenarios I can see happening, that's probably the one that has the most upward pressure to mortgage rates, which would probably send the housing market down further than I have been expecting over the last couple, 6 months. So just so everyone knows, like, that scenario is good for the economy, but could be pretty bad for home values. I know some people are hoping for home values to go down so they can buy cheaper, but that's just something I wanted to call out. And then the second thing I wanted to say is that, like, what Kathy's describing, what we're all describing, what we're trying to do here is just talking about like different scenarios that can happen. I just want to reiterate that none of us know, and we're just trying to play out and sort of like game what different things could happen so that you can think through some of how you would react to these things. So generally speaking, Jamil, given the uncertainty and these different scenarios that we're all positing that could happen, how do you sort of react with your own investing, your own money? Like, how are you operating in this uncertainty?
Great question, Dave. I'm operating the way that I would normally operate when I'm, as I said on previous shows, I am still very, very bullish on the fact that our inventory numbers, that real estate in general is not, whatever we're experiencing right now is engineered. This isn't normal market cycles, and we are lacking inventory across the country. So I am going to continue to buy. I'm going to continue to do what I would normally do. I'm just buying everything deeper. I'm doing what I would normally do, but more aggressively right now. And actually, funny enough, I'm historically known as somebody who doesn't hold a lot. I'm a wholesaler, so I like to flip paper and generate cash that way. But this last 6 months, I've been buying and holding property because I'm getting stuff at such steep discounts right now, and I'm watching inventory, and I can see what's coming around the corner. At least, maybe not next year, maybe not 2 years from now, but 3, 4, 5 years from now, the inventory that I buy today, I'm going to be able to take massive gains on. And I did this back in 2010. I bought $800,000 worth of property in 2010 that I exited in 2019 for $8 million.
Whoa.
Yes, that was one of the things that tipped the scales of my life, was being able to have that situation occur for me. So I'm trying to bet on that happening again. I'm holding, I'm buying aggressively. I'm going to hold really great assets at great prices, and I'm going to wait 5 years and see what happens with it.
All right. Well, great. That's very good advice. Henry, I'm sure you're doing something radically different than what you normally do.
Absolutely, positively not. We are doing exactly what we've been doing. I couldn't mirror Jamil anymore. It is, we talked about it before on another show, but like, when we talk about investing in real estate, right, people obviously want to buy low, right, so that they can either hold and build wealth and get wealth through appreciation and equity, right? Cash flow is great, but the real wealth is built through appreciation and equity. Or they're looking to buy low and then add value to it and then sell high. And so if this is what you're in the real estate space for, this is the time that's for you, because you can buy deep discounts right now. If you're in the real estate space because you want to be able to buy and sell, maybe the time frame that you're going to look to maximize your sell is longer. Like Jamil's saying, he's buying some, he's holding them for the short term, but his plan is to sell them when their value is at its quote unquote peak, right? When their value starts to go up tremendously. Also, if you're in a place where you're saying, hey, I don't know where to start, but I know I want to get into large-scale multifamily. I want to get into a space that takes a lot of capital to get into. Well, phenomenal. You could do exactly what Jamil's doing. You could buy at discounts right now. You can hold them, which increases your net worth. You're going to get the appreciation and the debt pay down over the next 5 years, but then you can leverage that, right? Increase your buying power to buy larger assets, then still sell those properties that you bought 5 years ago at a profit, right? So it's one way for you to get in now, where you're going to get in deep and use that leverage to start to scale. And then also for us, man, that we're getting such great discounts that we're able to do both. We're able to buy and hold and cash flow very well because we're buying at a deep discount. Even though the interest rates are higher, we're still cash flowing because of the depth of which we can buy. But also it's still profitable doing flips. I'm going to do my first 2 flips that we're going to sell here in 2023 are going to be triple digit flips, no pun intended there.
Ding, 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 ding. Let's go.
But to caveat that, these are 6-figure net profit.
So you're going to make $100? Triple
Yes.
You know how many messages I get on the internet just laughing at us for that title? But no, he means hundreds of thousands of dollars.
I had never thought about it. And someone else said it to me. I might have read it in one of your comments or something. I was like, yeah, okay. I guess there's a point, but I knew what you meant.
So when you talk about a triple digit flip, we're talking about a market in Arkansas where the spreads aren't as big as in a market like Phoenix, and so that's a big deal in this mid-tier market, especially with interest rates where they are and with home prices starting to come down across the country. We're still getting very, very high returns. I'm turning down projects that it would typically net like 30K because my time is better spent on the deals that are going to net me 50, 60, 70, 80, and they're still widely available. I just turned one down yesterday, and the wholesaler was like shocked that I didn't want to take the deal because I was going to only make a $30,000 profit. So there are plenty of opportunities still out there. And so our strategy hasn't changed, but our underwriting is different.
That's awesome. Thank you. That's super good advice. And Henry, you're always just smooth and steady, always doing the same thing. I like that. Kathy, what about you? Is there anything you're doing differently or thinking about just in terms of managing your investments right now?
No, I will speak from the perspective of somebody who doesn't do business where I live. I live in California. The regulations are ridiculous. The cash flow doesn't exist. Prices are still extremely high. I know some people invest here, but I don't. So I speak from the perspective of me and our members who have to invest somewhere else to make the numbers work. And looking at where that is today, there over the last couple of years, it was really hard for us because you're trying to compete, but you're not in the market, and you need somebody local there, but they've got 50 other clients, and like, how do you get that deal when you don't live there and you're kind of relying on somebody else? And for many of us who invest out of state and not in the area where we live, we like to, I'll speak again for myself and for people I represent, is something a little newer because you're not there. And so something newer and, or at least completely renovated feels safer, right? You kind of know what you're getting, and you can rely on, everything's already been fixed. I'm not going to have a lot of, repairs most likely on this property. And that type of property, sort of A, B class property, was almost impossible to get over the last couple of years. And new builders, I started investing with new builds, and new builders didn't want anything to do with investors. So like, why would I sell to an investor when I can sell to the retail market for more and not have a bunch of rentals in my subdivision? Well, all of that has changed. So from a perspective of somebody investing not where I live and helping other people build a portfolio not where they live, this is incredible. This is an incredible time. This is so much better than what we've been dealing with over the last couple of years. Now builders want to work with us, and they're giving us discounts, and they're paying down our mortgage. So it's like, we're in the money. Like, this is why we're so busy right now, because finally investors like me, out of state investors who already have jobs and already are working, and they can't be as awesome as Henry and Jamil. Like, they can't, we can't do what you guys are doing because we're not there. So the opportunities for us are so much better. And so I'm optimistic from that perspective that this is the time that I can now get back in and build my portfolio and still get pretty good rates. Because like I said, you can negotiate. You could negotiate for the seller to help pay down pay points to pay down your mortgage.
Awesome. That is also great advice. And I think that's reflected across a lot of other experiences that we've been hearing about, people we've been interviewing on this show. All seem to think that there's great opportunities out there. There's also a lot of crap out there, I will say. So it really is about finding good stuff. I will say that, like, for me, I am actually doing a few things differently. I am starting to get into lending because interest rates are really high right now, and it's a good market to be in lending. And the second thing I'm doing, just generally speaking, is looking for to put some money into short-term opportunities right now, because as if you listen to the show know, I mostly invest passively in commercial real estate. And I do think commercial real estate is going to be taking a hit in terms of valuations, and there's going to be really good opportunities. I know I always say don't try and time the market, but I'm not listening to my own advice. I'm going to try and time the market a little bit with commercial real estate, but I'm still investing my money for now, looking into like shorter term opportunities that I can still earn a really good yield for 6 months, 12 months, and then trying to see what happens. Just, as we've been talking about this whole episode, no one knows what's going to happen. So I'm trying to buy some flexibility with my money so it can take advantage of even better opportunities if they come over the course of the year.
I just want to say that I want to be the first to call Dave the hardest hard money lender on the market.
Thank you. I don't really know what that means.
The amount of people that are going to DM you asking for money.
I should have. That's a good point, Henry. Sorry. Now people are going to ask me for money for sure. I don't have a lot of it, so don't ask me for that much. You're better off asking someone else, or ask James. He lends out a lot of money. All right. Well, thank you all for being here. This was a lot of fun. I hope you all enjoyed this debate. As you can see, everyone's just trying to figure out what's going on. Hopefully this helps you understand some of the indicators to look at, some of the sentiment that is occurring in the market right now, and how you can prepare yourself for the weird, whatever you want to call it. You want to call it recession, go for it. You want to call it something else. Whatever it is, it's weird. The weird economy that we are in right now.
The mullet. Yeah, the mullet economy.
The mullet, exactly. The mullet economy. I feel like we need like a graphic for that. Yeah. All right. The mullet economy. All right. Well, let's just do a little round of where to find you guys. If you want to learn more about the mullet economy and Jamil, where should people contact you?
You can follow me on Instagram at JDAMJI. Also, I have a pretty fun and entertaining YouTube channel where I teach people how to wholesale real estate and can crack you up a couple of times. So you can find me on youtube.com/Jamil Damji.
It is funny because you can find a video of Jamil and I in pajamas doing interviews about real estate on that channel.
It was a great interview. People loved our jammy jams.
That sounds awesome. I haven't seen that. I want to see that. Well, Henry, what about you? Where can people find more about you in your pajamas?
Instagram, best place for me. I'm at the Henry Washington on Instagram, or check me out on my website, henrywashington.com.
All right, great. And Kathy?
I was going to say Instagram too, at Kathy Fettke, but make sure it's 2 T's because there's somebody trying to be me, and don't listen to them with 1 T. It's two T's, Fettke. And then probably a safer way is realwealth.com, where nobody's trying to impersonate me there. I don't think.
God, the impersonators are unbearable on Instagram. It's ridiculous.
It's ridiculous. And they're asking for money. So that's not me. I'm not asking anybody for money.
Kathy, I heard you mention a couple of times that you were having trouble getting a reservation for dinner. Did you tell them that you were Kathy Fettke of Real Wealth?
Oh, no, I didn't use that card.
No, it's because they thought it was Kathy Fettke with 1 T.
They thought you were... Yeah.
It was the 5th Kathy Fettke who had contacted the restaurant that day.
You cannot have a reservation and you cannot pay with Bitcoin.
Yeah, they asked, Kathy called the restaurant and asked how their crypto trading was going 3 different times.
And I'll help you if you just give me $5,000. I'll invest it for you.
Seriously though, if you are listening to this just public service announcement, like if someone, any personal finance person, if the 4 of us, anyone else contacts you and asks you to trade with them, particularly Bitcoin or Forex, read very carefully the username of the person who is asking you, because it is very likely to be a scam. Please report them. I think I speak for all of us that we report all the people who impersonate us, but Instagram and Meta is very, very slow to remove them. So just be careful if you ever see that. Oh, I know why. Because their stock price is down 70% and they don't want to reduce engagement even more.
Oh, now the people with black suits are at Dave's store.
Now I'm the conspiracy theorist, right, Henry?
Yeah, I mean, I don't know about that, man. The ability, like, it would be so easy to write an algorithm to stop them for doing that, and they just don't do it.
100%.
But it's the same thing, right? Isn't that what like Elon Musk sued Twitter about, right?
Yeah.
Was that like so much of the engagement is bots?
Yep.
But they're just like, we don't know what's going on, because then they don't have to report it to their investors. Anyway, don't shadow ban me, Instagram.
It's a love-hate relationship.
So good.
All right, we're going to get out of here. See you all next week. Thank you all for listening. We'll see you for the next episode of On the Market. On the Market is created by me, Dave Meyer, and Kaylin Bennett. Produced by Kaylin Bennett. Editing by Joel Esparza and Onyx Media. Research by Pooja Jindal. And a big thanks to the entire Bigger Pockets team. The content on the show On the Market are opinions only. All listeners should independently verify data points, opinions, and investment strategies.